So I'm Sarah from the PASMA and Ladder Association. Thank you for joining us today for the Brexit webinar. I'd like to introduce Kevin Shakespeare from the Institute of Export and International Trade, who's going to share with us lots of information this morning with regards to Brexit. There will be an opportunity for any questions and answers later on in the session. If you could please add those to the question and answer box, which will appear below the slides on your screen. I'll now hand over to Kevin. Good morning, Kevin.
So it's a pleasure to be able to present to you today to talk about Brexit. So during the call, I will be linking to some slides which will be available to you with regard to Brexit. So I'll just see, apologies, can I just check if you can see my screen or whether I need to share my screen, which I will do. So hopefully you will now be able to see my screen. Please let me know if that's not the case. So during today, we'll be looking at what Brexit means for the working at height sector and how to plan ahead. So Brexit, the content today we'll look at issues around customs, tariffs and taxation, regulation and compliance, staffing and human resources and intellectual property protection. And obviously any further points that you would like to consider. And clearly there will be time available for questions as well. Now, it is important, I guess, in the context that there are so many Brexit issues to bear in mind. We will do our best to cover as much as possible within the content areas. So Brexit, first of all, where are we? And we hear about it in the news every day, but what does it mean? But most of all, what does it mean for your businesses? That's the most important thing here. Not so much what's at a political level, at a speculation level. What will Brexit and what could Brexit mean for your business? So a lot's been talked about what's the difference between trading in the European Union and trading outside the European Union, and the slide on screen goes through some of the differences in that respect. So the UK has been a member of the European Union now for a number of years, and we enjoy the concept of tariff-free trade. So goods move around with no tariffs applied to those goods within the European Union member states. We're used to being part of a customs union, so we have common customs procedures, whereas it's only if you're trading outside the EU that companies have to get involved with the likes of customs processes and customs declarations. A big area that's been talked about recently from a political level and a speculative level is the concept of a level playing field. And that could be in terms of no non-tariff barriers. So the whole of the European Union is aligned in terms of regulations. Clearly, if the UK leaves the European Union, there's been lots of comment and lots of talk in terms of there being not being a level playing field. The free movement of people. We're used to people being able to move around the European Union to live and to work with free movement, and clearly that will change, and we'll look at that during the course of this webinar. The UK has to operate within the EU's trade policy. So the UK is free then to set up its own trade policy or independent trade policy, which we'll also look at because there's a few initiatives clearly that could take place during this course of the year and next year. And then there's dispute resolution. So something that doesn't come up too much, but is an important area in the event of trade disputes as to what will be relied on if the UK leave the European Union. So there's no doubt that if the UK leaves the European Union, or when it leaves the European Union, it will revert back to World Trade Organization, WTO rules. And it's only if the UK strikes a trade deal of some shape or form, which we'll look at with the European Union, that some of these implications of the World Trade Organization trade in would change to a more formal relationship. But I would stress not as formal as the UK has interacted with the European Union now for some years. I also want to make the point, though, that lots of different types of business will be impacted by Brexit. whether that's deemed as positive or negative. And if you're selling to a UK company, you could also be impacted as almost an indirect exporter. So if that UK company is exporting themselves, they will be impacted. If you have competitors in Europe that are supplying UK companies currently, or competitors of yours, that may give you an opportunity to sell more to that UK company because of potential barriers to trade. So UK business is in scope as well. And as we're going to look at, business with the rest of the world is in scope with regard to Brexit. This is not just about the UK and the European Union. So now let's look at the timelines for Brexit. So the withdrawal bill is currently going through government, through Parliament, and the House of Lords have proposed some amendments, which the UK Parliament can choose to accept or choose not to accept. But the basic principle is the UK is still looking to leave the European Union officially by the 31st of January this year, 2020. And after the 31st of January, the UK enters a transition period. And that transition period commences on the 1st of February. And to all intents and purposes, the wording coming out from government is that that transition period runs from the 1st of February to 31st of December. Now, as we're going to look at, by and large, that means procedures of trading with the European Union stay the same during the 1st of February to 31st of December. But there is possibility of some divergence, which we'll refer to as well, during that transition period, although by and large that should be the case. I would stress, however, that awareness of things remaining the same during the transition period may differ. So the level of awareness in Europe of Brexit is clearly less than it is in the United Kingdom. So there is propensity for some misunderstandings whereby EU businesses and EU suppliers think we possibly left, or when we're leaving, that there is no transition period. So as we're going to talk about, communication is fundamental and an understanding to avoid misunderstandings and loss and damage to business. So during the month of February, the EU requires to sign off its negotiating mandate with the United Kingdom. So level playing field, regulatory alignment are some of the issues that the EU will discuss. So from the 1st of March, formal negotiations begin between the UK and the European Union, ultimately towards hopefully a trade deal. And that trade deal, the focus of it is likely to be zero tariffs or a comprehensive free trade agreement. Now that could be zero tariffs on all goods, it could be on some goods, or it could be on most goods. So that will be the focus, and it's certainly the focus that's mentioned. But there will be discussions on other elements of how we work with the European Union, for example, on fisheries policy, but also mutual recognition, whether it's on data protection, what does the future world of customs look like? It is fair to say that the UK government has been emphatic that negotiations will not include regulatory alignment, and that includes no regulatory alignment in terms of customs processes, as we will look at. And that trade agreement has to be signed by a certain period in 2020 for EU states to agree the trade deal. And each EU member state and regions of each member state have to agree a trade deal with the United Kingdom. And historically, that takes 6 months to go through that process. So there is pressure to try and strike a trade deal by the end of June. Obviously, there could be flexibility on that 6 months. But by the 31st of December, the UK government has been, again, emphatic. The transition period ends and the UK, again, leaves the European Union and is fully outside of the European Union with no transition period. There is, however, the possibility of some interim deals pending more comprehensive deals if things are not ready in time. But we shall see. So what should businesses expect during the transition period? Now, the working assumption is that everything remains the same, but we cannot legislate for how businesses in Europe and businesses in the rest of the world will treat the transition period. They could be some misunderstandings that the UK has fully left the European Union on the 1st of February, and that could reflect. So important to have those discussions now with your customers, your suppliers, and your stakeholders. And those discussions could include the impact of any tariffs were they to apply after the 31st of December this year. So in other words, if there is no trade deal. It could be discussion on the ongoing terms of trade, and we'll look at Incoterms, of which some of you may be familiar, and customs declarations. And also the impact of any changes in regulatory alignment, and again, we'll talk about that. But also at the end of the day, if you are talking with your customers, suppliers, and stakeholders, and sharing knowledge, sharing opportunities, does that give further opportunities to generate more business? So, but by being open about the issues, the challenges, but also the opportunities, you could be more proactive than your competitors. So, could that give you an opportunity? Now, I just wanted to mention here that any companies which are part of cross-border corporate groups, so if you have a parent company abroad or you have subsidiary sister companies in Europe, there are ways in which you do have, I'll say, a unique set of issues, but different issues to consider. So we'll look at GDPR later and binding corporate rules as a group. The trading, the customs value of goods you're transferring, I'll talk more about that, and also any element about tax treaties and moving money around as well, because the UK is going to have to agree potentially tax treaties with each EU member state in terms of money moving around and trying to avoid double taxation and withholding tax. So those are unique issues which I appreciate group companies and group parent companies may already have addressed or certainly be looking at. So now let's look at customs, tariffs, and taxation. So the general principle is tariffs make it more difficult for an exporter to win export sales. And tariffs, when we refer to tariffs, are effectively import tariffs. When you export goods, an import tariff is payable. And that import tariff makes your goods more expensive. And we'll talk more about what tariffs could apply and how to identify them shortly. The only way to avoid tariffs is through trade agreements, and again, which the UK is looking to sign with the European Union in terms of maintaining zero tariffs. But currently, the basic principle is that unless that trade agreement is signed, and at the end of a transition period, tariffs will apply to UK trade to the European Union and potentially the other way around as well. But it's not just trade with the European Union. There's also trade with the rest of the world to consider as well. So the European Union has trade agreements with 74 countries around the world. And we'll look at examples of those countries shortly, which also means that trade between the European Union member states and those countries is tariff-free. But also some of the barriers to trade like packaging and labelling are also reduced as well. When the UK leaves the European Union, it loses access to those trade agreements. And there is potential, it's unlikely, that issues could arise from the 1st of February. It's more likely to be the 1st of January next year, but it's only fair to mention that for some countries, and we'll talk about possibilities there could be additional barriers to trade from the 1st of February if those countries do not accept the UK is still a member of the European Union during the transition period for trade purposes. Now, the 74 countries that the EU has trade agreements with, there's a web link you can see, and you can access that to see which countries and the status of trade agreements. We'll talk, as I said, about those countries. Now, what the UK is trying to do is roll over those trade agreements. So in other words, trade with those countries remains the same as it is today. And where we are at the moment is the UK has rolled over 20 agreements covering 50 countries. So that's good. But let's be clear. The European Union does not have trade agreements with China, no trade agreement with India, and no trade agreement with the United States, or no trade agreement with Indonesia, for example. The trade agreements the UK has managed to successfully roll over are detailed on the left-hand slide of slide 10. And there are some big countries there, Switzerland, South Korea, for example, Norway. But there are some big countries that the UK hasn't managed to roll trade agreements over. And if you look to the right-hand side of the slide, you'll see Canada, Japan, and Turkey as examples of that. Those trade agreements are still to be fully agreed, the rollover. Canada is probably more likely to happen in the near future, but both Japan and Turkey have indicated they want to renegotiate the trade agreement, and are obviously looking for some form of reciprocation from the United Kingdom. So in theory, trade, if you looked at this with the likes of Japan and Turkey, for example, could be subject to tariffs if no trade continuity agreement is signed. Again, that remains to be seen. Equally, however, though, under an independent trade policy, the United Kingdom can sign or commence trade discussions with other countries. So certainly trade discussions with the United States has been talked about, and Australia and New Zealand, for example. The European Union is negotiating trade deals also with Australia and New Zealand, but it's less likely to be with the United States. And any of you trading with the United States will be aware that the United States has levied additional tariffs on the United Kingdom of on the European Union of 25%, which is affecting sales of UK products to the United States. If the UK is outside of the European Union, it will be interesting to see what the US policy is towards the United Kingdom. But certainly the United States has been talked about as a potential trade deal. Obviously, there are lots of ramifications to consider there. But the UK, in theory, is there to can negotiate trade deals with the US, with India, where there's no trade deal, for example, Gulf countries, for example, Australia, New Zealand. And the UK is working hard on trade deals where, for example, not just rolling over the EU trade deals, but new trade deals as well. It will be interesting to see what happens during the course of this year in that respect. Now, we've talked about tariffs and the impact, but one way of identifying, and you may be aware what your tariffs are currently, is to look at you can look at the gov.uk site. There's a site for the European Union on Europa EU. There's also a site which I've indicated here, which is the World Trade Organization themselves. And you've got the web link there on screen. So what you do is click into that, and you would then have a list of countries. So every member of the WTO. For a trading bloc like the European Union, it's shown as the EU and not by individual countries. You would then key in your commodity code. Now, I've used as examples 72 and 73. You may have other commodity codes. So just to be clear here in terms of commodity code is like a product code. It identifies the code for your product set first of all at a global level at the WTO, and then filtering down to individual levels to the European Union. And that commodity code is absolutely fundamental. It's fundamental that you get the correct commodity code, that you pay the correct level of duty. So import duties are calculated on commodity codes. So you can identify what your commodity code is. You would key it into the find function here. You would key next, and it creates a spreadsheet. What I'm happy to do for you is if you can identify some commodity codes for your products, I can filter a few spreadsheets for you. I did look at the 72 and 73 ranges. Bear in mind that on the plus sign here on the left-hand side, if you clicked on that, you would have lots and lots of different subcodes until you got to windows, to doors, to ladders, for example. So it is fundamental you get the correct commodity code, and customs will take a keen interest in that. And the tariffs for some of your products to the European Union varied. Some were 0.3%, some were 0.7%, some worked their way up to 7%. That was the highest, and that wasn't very many. So, but the theory is exporting could become harder if there's no trade deal, if there's tariffs applicable. So tariffs is a key area, clearly. So what about imports? We've talked about exports here. And sorry, just coming back to a previous slide, if you wanted to check what tariffs were to the United States, to Japan, if a continuity agreement is not signed, you can also filter it by those countries and not just the European Union. And again, if you provide some country examples, we can call up some spreadsheets and send them to you, or produce some spreadsheets and send them to you as well. But what about imports? The theory is on imports. There is some potential good news. Not that it's all bad news, clearly, in terms of the exporting side. You have a link to a website here where the government has announced what they call temporary import tariffs. Now, these temporary import tariffs were effectively introduced in March last year, before the potential leaving date at the end of March, and October they were updated. And the general principle is that the UK is eliminating tariffs on about 88% of imported goods. So, and that could be goods imported from China, the United States, India, not just goods from the European Union, every member of the WTO, all 164 members. The tariffs that will apply, if you like, the 12%, will generally be agricultural products, food, drink products, and also finished goods. The UK does not want finished goods coming in. The UK wants supply chains, and it wants employment. So finished cars, finished clothing, for example, will be tariffed, and quite heavily as well, to avoid the import of finished goods. Now, I had a quick look for some of your products in the 7273 commodity code, and I couldn't see any tariffs applying for them. However, again, if you send a commodity code, we can look at that more specifically. But the basic principle is that in 88% of imported goods into the United Kingdom, there will be no tariffs, which is not, as I've said, not just the EU, but the US, China, and other countries as well. Now, this is quite a detailed slide, but let me talk through it. We're starting to get into the territory now of a trade journey. Now, I've chosen this example, an exporter in Paisley, and the reason for effectively having all these different columns is to look at different elements of the trade journey. So the exporter is based here in Paisley. The first start of a trade journey is the goods are loaded onto the lorry at Paisley. In this case, the goods move from Paisley to Felixstowe, and they move ultimately through to Antwerp as the port of arrival in the European Union, and move on to the buyer in premises in Essen, Germany. Now, these are all different stages defined by Incoterms, international commercial terms, which we will look at shortly. And it is important to recognize that currently goods move in frictionless trade. There are no customs declarations required. If the UK leaves the European Union, there will be 2 customs declarations. There will need to be an outbound declaration, in this case at the port of Felixstowe, and when the goods leave the frontier of the United Kingdom, and an inbound declaration when the goods land in the European Union, in this case at the port of Antwerp in Belgium. Somebody has to make those declarations, and ultimately it's either the UK exporter or the European buyer. It can be either or, and we'll look at that more. But those customs declarations have to be made before the goods arrive for Felixstowe on the outbound leg of the journey, and before they arrive at Antwerp on the inbound. So there's responsibilities here for customs declarations. And irrespective of who makes that customs declaration, the responsibility is down to the trader, the exporter and the importer. They are responsible in law for that customs declaration. If any information is incorrect, then customs will look to the exporter and the importer, the party who made the declaration. Even if you're using a freight forwarder, an agent to make the declaration for you, you are responsible for giving them the information, which we'll look at, and you are responsible for anything wrong. So any wrong commodity code, any undervaluation of goods, for example, anything wrong with the origin of goods is responsibility of the exporter or the importer. So clearly, customs declarations is a key element of the UK leaving the European Union Customs Union. And there's also going to be more trade documentation, which we'll look at as well. And authorities will look more closely at the trade documentation than they've had to do previously. in many respects, the working assumption is currently that the way the UK trades with the European Union would be the same as United Arab Emirates, the same as the United States, same as Japan, Morocco, etc. That is the working assumption, because the UK has said there will be no regulatory alignment with the European Union. Now, Incoterms. Incoterms, you may be familiar with, stand for International Commercial Terms. They determine who is responsible for what part of a trade journey. You can see, for example, X works at the top. So the concept of under X works, which you may be familiar with, is a lorry turns up at your premises to collect the goods. And you just make the goods available at your premises. You do not load the goods on the lorry. If you do, you're potentially invalidating use of, and if there's any damage to the goods, it becomes your responsibility if you're using X Works Incoterm. But under X Works, the European buyer is also responsible for the customs declaration, not just in the inbound declaration in Antwerp, in our example, but the outbound declaration in the United Kingdom. That is an awful lot of responsibility. They're also responsible for tariffs, all trade documentation. So that is a big undertaking, and we are aware that a lot of trade between the Europe and the UK does involve a lorry turning up at the premises of the UK exporter. There is another Incoterm, FCA, free carrier, where the goods effectively turn up, where the lorry still turns up, but responsibility for loading is the responsibility of the UK exporter, and the UK exporter is also responsible for the customs, the outbound declaration, in this case to the authorities in Felixstowe. Then you have at the other extreme of delivered duty paid, DDP, where you as the exporter are responsible for delivering the goods to the buyer's premises, in this case in Essen in Germany. You would also be responsible there for all customs declarations, the outbound declaration in Felixstowe and the inbound declaration in Antwerp. You would be responsible for any tariffs that apply, import duties as well. So that creates an enormous amount of responsibility on the on you, the UK exporter. You may choose to use delivered at place, DAP, where you are still responsible for the lorry and going to the premises of the overseas buyer, but you are not responsible for tariffs in the European Union, import duties, and you are not responsible for the inbound declaration. But all this shows is that UK exporters and UK importers on the reverse side have to agree and be clear on the Incoterms, because there is more work here for businesses that businesses need to do. And I appreciate your businesses may have already looked at this issue, but this is one of the biggest Brexit issues outside of tariffs, around losing access to the customs union and more customs procedures being required. So we've identified that customs declarations are required but in this example, when goods leave the EU and when goods enter the UK or enter the European Union. And we've identified it's a responsibility of the UK company or whoever is making that customs declaration. But you can ask a freight forwarder or agent to make the declaration on your behalf. And if they're carrying the goods, they will obviously have, for example, the bill of lading. If the goods are moving certainly by sea, or the airway bill, for example, if they're going by air. So they know the transport journey, but you are still responsible for advising them of the commercial invoice, the packing list, and any other regulatory requirements in the export transaction, which is why in the eyes of customs, it is your responsibility if you're making the customs declaration. So you would need to agree with the forwarder. And it is fair to say that freight forwarders are extremely busy at the moment. Their emphasis is their existing customers as opposed to any new customers. So what we do say to businesses, don't assume there are lots of freight forwarders out there to make customs declarations. If they're already moving the goods for you, then you've got an existing relationship with them, which is a better place to be. Now you can make your own declarations. You would need to purchase software and do even more training for your staff. But customs grants are currently available up to the 31st of January. So because of this big impact in terms of customs declarations and customs processes, HM Revenue and Customs have provided grant funding to UK businesses, which you apply in this case to PwC. Now, the grant scheme is currently due to finish on the 31st of January. Obviously, there may be announcements of what happens after that, and we're all waiting to hear. But technically, businesses have up to the 31st of January, and ideally a few days before, to apply for grants. Now, those grants are invariably up to a maximum of £2,250 per employee of a company. Sometimes it could be capped for an employee at £250 for a day's training course, but sometimes it can be at higher level. Even professional qualifications can be studied as well as part of this. So customs grants, if you haven't looked at it already, do look at it, because money is available to try and professionalize and help businesses import and export. Excuse me. So making a customs declaration, I'm not going to go through this slide in detail, but it's important to bear in mind here that you are responsible for the commodity code. If you're not sure of your commodity code, and especially if you're using the other category, which is a red flag to customs, anyone using other in their commodity code, you can ask for a binding tariff information, a BTI from HMRC. That could be good practice, because if you're using the wrong commodity code, you could be liable to fines from customs. The other thing to mention for importers you may have heard of is transitional simplified procedures. So these are procedures that the UK government is trying to introduce to make it easier to import. The UK can control imports more. So less inspection of goods. The theory is outside of the European Union that goods will be subject to more inspections. Less inspections, deferment of duty, deferment of VAT. So transitional simplified procedures, do look at it. Companies that are VAT registered should have automatically been registered. Make sure you have the letter from HMRC. VAT, the treatment of VAT changes as well. The basic principle here is that import VAT becomes immediately payable when the UK leaves the European Union. So if you're selling to the European Union, your EU buyer will have to pay VAT immediately on importation, unless they can defer payment through the likes of bank guarantees. Are your European customers aware of that? From the 1st of January next year, they will have to pay VAT sooner. On the import side VAT, import VAT is also payable by you if you're importing, but the government has introduced postponed VAT accounting to assist you. Again, you should have received an automatic advice. You have the links there. It allows companies, UK companies, for a temporary period to postpone payment of VAT to help cash flow. Final element, or as we come towards customs declarations, is around proof of export. Customs require every export to have full documentation, commercial invoices, goods departed message for customs purposes. I will leave you to look at that slide, but do consider it. We are getting now into more of, if the UK leaves the European Union, rolling the clock back to the 1970s, where customs declarations are required for everything and evidence of exports needed. Otherwise, you invalidate VAT, be liable for VAT, and also liable for a fine. So do look at proof of export, important. Ensure the correct valuation of goods. So one thing is that customs will be looking at your commercial invoice and your customs declaration. And customs will know in the UK and the EU what the value of goods are. They have a metrics and a computer system that provides the value of goods. So if there's any undervaluing of goods, companies unfortunately will be subject to fines. It's fair to say that customs are taking a keen interest in this area. Previously, because customs declarations are not required between the UK and the EU, there wasn't the level of scrutiny that there will be. So just wanted to mention that. Make sure you insure your goods in transit. Again, this Brexit is bringing out the fact that some UK exports are not being, on imports, are not being properly insured. Your forwarders and your carriers have limited liability, which means that your goods will not be insured for their full value. So I appreciate a lot of you will insure your goods already, but if you're not, it's something you need to consider. As I said, speak to your freight forwarder, look at your freight routes. There was a lot of concerns about congestion around Dover and Calais in March and October, and obviously the Channel Tunnel, but speak to your freight forwarder, make sure your freight slots are secured, especially as we head up to November and December this year. Regulations and compliance. So I'll just cover a few things here, but if any of your products carry the CE mark, I know a lot of them don't, please raise a question at the end and I can speak about requirements for the CE mark. That will change. Because of time limitations today, we're not going to cover custom special procedures, just as warehousing relief schemes, but it's fair to say that awareness of custom special procedures and abilities to defer, eliminate payment of duty in the UK and the European Union legally will become greater. And there are ways of doing that. And not just the big companies that are able to do it, small companies are as well. So again, it's something we're happy to discuss further in terms of use of custom special procedures. And the grant schemes, again, talk about these and how businesses can optimize and maximize their supply chain. If any of you are providing consultancy services as trade-in services, please raise a question and I'm happy to discuss that as well. Origin. Now, origin is one of the biggest issues in Brexit. So if, for example, the UK strikes a trade deal with the European Union for zero tariffs, the UK will still have to demonstrate that the goods are 60% UK origin, 60% UK nationality, at 60% of the cost value, normally evidenced through the commercial invoice. If UK companies are not able to do that, then there will be tariffs on goods entering the European Union, even if there is a trade deal. Obviously, the trade deal will look at the rules of origin and what the percentage of origin is. It's at a world level, it averages 60%. But if you are part of complex supply chains with EU, with China, with the United States, you might want to look at how much of your origin is UK. Is it 60% of the price at which you're selling at? So just wanted to mention that, which is why we've seen changes in the automotive sector, for example, with very complex European supply chains. If you're not using the CE mark, some of your products may be known as non-harmonized goods. And the general principle is if you're selling within the European Union, it's the country of first sale principle. The UK is part of the European Union, which means that you have to meet the packaging and labelling requirements of your country of first sale, which is the UK. When the UK leaves the European Union, you can no longer include the UK. So you will need to meet the packaging and labelling requirements of the first country that you sell into the European Union. So think very carefully at the 1st of February next year, which the first country of sale is. Pallet availability, you may have heard this. If you're using wooden packaging, wooden pallets, they have to be specially heat treated and ISPM 15 compliant to enter the European Union after the 1st of January next year. So look at your wooden packaging. If your forwarder or someone else is providing packaging, does it have the logo at the top, ISPM 15 certified, specially heat treated to avoid spread of beetles and pests? Have a look at that. Not sure it'll apply for your goods, but if you have any goods that have a military purpose as well as a civilian purpose, which can include software and technology as well, you may require an export license. Now, if you're selling to the US, Japan, China, you will require one currently, but even when the UK leaves the European Union, you may require an open general export license. There is a list of controlled goods, and you've got the web link there, which you can click on to see those controlled goods. And we can also send you for a spreadsheet as well. But increasingly the world we live in, businesses have to demonstrate the end use and the end user. So if you're selling to the military in Europe, for example, or it's moving from Europe to military in war zones in the world, you will require an export license. Not saying that will apply for your businesses, but do consider it. Other Brexit issues, and again, probably we'll start to move on to questions very soon, is EU nationals. So since the 30th of March, there's been an EU settlement scheme to allow EU nationals to apply for settled and pre-settled status, which allows EU nationals to use the NHS going forward, take advantage of pension schemes and work employment benefit. Settled status is where you've lived in the UK for more than 5 years. Pre-settled status under 5 years. So since the scheme was formally announced, 2.6 million EU nationals have applied to the EU settlement scheme, and 2.2 million have been accepted, 59% for settled, 41% for pre-settled. EU nationals have up to the 31st of December this year to apply to the scheme. So if an EU national in your business has not done so, they should seriously consider doing so, because after that, there will be a new immigration system in the UK which will apply to anyone from anywhere in the world, not just the European Union. The UK announced a temporary leave to remain scheme, and further announcements will be waited, which allowed EU workers to enter the UK and apply for temporary leave to remain for 36 months. Now, further announcements will be allowed on this, made available on this, but the basic principle at the time, in October last year or September last year, was that EU workers would be able to come and live and work in the UK and apply for temporary leave to remain to work here for 36 months from the date of granting. And if they came over this year, they could apply to 31st December. So it's important to look at updates on that, and we will also keep everybody updated. If you have UK nationals working in the EU, they should similarly consider settlement status in the EU country in which they work. In most cases, and it's down to each individual EU country, it's possible to apply for settlement status, for example, in Germany, in Spain, until the end of the 31st of December this year. However, we strongly suggest that the employer and the employee check what the rules are and what the cutoff date is for the particular country. Traveling, general principle currently is, and I do stress currently, is that if you work in the European Union, you'll be able to travel visa-free, this is for workers, for 90 days in any 180-day period in the Schengen area, which is 26 countries. If you're driving abroad, you may require an international driving permit. That varies by country, and you have the web link here, which you can click on to check the rules by each individual country. GDPR. The basic principle here is that companies must have standard contractual clauses with anybody they hold data on. This is consumers. That could be an employee, it could be a customer. If you're booking a hotel, for example, for one of your customers to stay in the United Kingdom, you hold personal data on them. So you must have standard contractual clauses, and those standard contractual clauses must be in accordance with the guidance from the Information Commissionaire's Office in the UK, the ICO. I'm aware some UK companies have clauses which don't meet the ICO requirements, which could leave them potentially in breach of GDPR when the UK leaves the European Union, or formally on the 1st of January next year. However, there could be mutual recognition of GDPR standards this year, but it's good practice. You'll all be familiar with the importance of GDPR. Trademarks, if you hold trademarks, the general principle is that your EU trademark will be cloned to also create a UK trademark, but you need to make sure that's the case, obviously from the 1st of January next year. And finally, terms of sale. Look at your contractual agreements, because clearly Brexit has the possibility of creating more issues around contractual sales. So look at dispute resolution clauses, arbitration. Is it an EU body? Should it be changed to the International Chamber of Commerce or some other independent arbitrator for your industry? Look at your terms of sale and your contracts in the event of disputes. That includes your pro forma invoices, your quotations, your commercial invoices, not just your formal terms of sale. Okay, that probably concludes most of what I wanted to cover today. We've covered obviously an awful lot in the time available, and I'd very much like to take any questions now. Thank you.
Thank you, Kevin. So the first question we have today is asking if the slides will be available. Kevin, if you're happy with that, we'll share the slides after today's event.
Yes, that's absolutely fine. Happy to do so.
Fantastic. And if anyone has any more questions, if they could put those into the Q&A box now. The next one that we've got, what is the number one thing a UK manufacturer who imports raw materials can do today to prepare for Brexit?
I guess the number one thing they should probably do is make sure they're in communications with their supplier. So both supplier and manufacturer are clear on what the impacts could be from a Brexit perspective. So whether there'll be any import tariffs in the United Kingdom, and look at the link to the commodity code as to whether there would be or whether it would be zero currently. Whether customs declarations will require, which is highly likely, and who is responsible for those customs declarations in accordance with the Incoterms. VAT, so is everyone clear what their responsibilities will be on the 1st of February next year? That's probably the biggest thing, and that can only come about through discussion with the supplier overseas.
Thanks, Kevin. We do have another question on VAT, and that's, do UK businesses need to add VAT to their invoices when exporting to the EU?
Okay, good question. Yeah. So basically, currently, if anyone's exporting outside the European Union, you'll be familiar that you zero rate your exports for VAT, but you must retain proof of export as the slide indicated, otherwise you will be liable for VAT. The same will apply now to the European Union when the UK leaves, or officially leaves after the transition period on the 1st of January. You will zero rate your exports for VAT, but you must have proof of export, which includes a goods departed message on the customs declaration. Import VAT will be payable immediately by your European buyer unless they can find some way of deferring payment of that VAT. They'll be able to offset it in their VAT return. However, it will be payable immediately unless they can defer it, for example, for a bank guarantee to their customs authority. So that's how VAT will work post-Brexit.
Thanks, Kevin. Have we got time for one more?
Absolutely, yeah.
Excellent. So the question is asking, do we know when we will know if the UK businesses will be impacted by tariffs with the rest of the world?
Okay, yeah, good question again. So certainly, as we've talked about the import side and what the UK announced in terms of their temporary import tariffs, there'll obviously have to be another announcement from the 1st of January next year. With regard to the rest of the world, the general principle is we know now. It's all in that WTO link on the slide that I called up. Now, the question is those are the tariffs that these countries quote to the WTO that applies for exports or sales from every WTO member. The link on slide 11 here. Now, those tariffs are already published available through this link. The only way those tariffs are avoided, if you like, is if there is a trade agreement with the United Kingdom. So again, if we go back up to slide 10, you'll see countries where there are trade agreements on the left-hand side. Some of them are trading blocks, they're not just individual countries. So that is obviously something to bear in mind there. So important in that respect to note that. Obviously, the UK is trying to negotiate other agreements, both continuity agreements with the Japans, the Mexicos, Turkeys of this world, where the EU already have a trade agreement, but effectively trade agreements with the United States, with India, Australia, and New Zealand, which means that goods would enter those countries free of duty. So clearly, if the UK strikes a trade deal with the United States, that could be a very big trade deal, which will clearly benefit some exporters. Obviously, it would benefit the United States as well. So I hope that answers the question.
Thank you, Kevin. Doesn't look like there's any further questions coming in on that. So if I could take the opportunity to thank you for the information you shared with us today, and thank everybody for signing into the webinar. As we mentioned earlier, we will circulate the slides afterwards, and if anyone has any questions, perhaps we can feed those back to you further.
Yeah, no, absolutely. Happy to do that. And as I said, if anyone wants to advise commodity codes, we can look at examples of what specific commodity codes are. As I said, I made a certain assumption around the 72 and 73 categories, again on slide 11. But you should be able to call up a spreadsheet yourself by using the find facility on the slide. But if you're unsure, if you give us a commodity code, we can look at that for you.
Lovely. Okay, thank you then.
Lovely. Okay, brilliant. Well, thank you very much. It's been a pleasure to present. Thank you.
Thank you, Kevin. Thank you, everyone, for dialing in.